TFSA, RRSP, FHSA, 3 accounts, 3 rule books, and everyone swears theirs is the best one. Here's the truth. One of them is right for your situation. And it's probably not the one your bank pushed you into first. By the end of this, you'll know exactly which order to fill them in, plus the retirement trap that can quietly claw back your government pension money. That one surprised me. Stay for it. Quick confession, so you know I've earned this. I held all 3 of these accounts and filled them in exactly the wrong order for years. This is the cheat sheet I wish someone had handed me. 30-second version, account 1, TFSA. The money going in is already taxed. But then it grows and comes out completely tax-free, forever, no asterisk. Account 2, RRSP, you get a juicy tax deduction today, but every dollar you pull out later gets taxed as income. It's a deferral, not a gift. Remember that line, it decides everything. Account 3, the weird hybrid, FHSA, an RRSP-style deduction going in, TFSA-style tax-free money coming out, as long as it buys your first home. Here's the 2026 room on screen. TFSA, $7,000 a year. FHSA, $8,000 a year, $40,000 lifetime. RRSP, 18% of last year's income, capped at $33,810. These change yearly. Check before you contribute. Now, the only rule that actually settles TFSA versus RRSP, if your tax bracket is higher today than it'll be in retirement, the RRSP deduction wins. If it's lower today, the TFSA wins. That's the whole argument. The refund is just future use money coming back early. And if you've never owned a home, the FHSA jumps the queue. It's the only account in Canada that stacks both perks. There is a catch, and it's coming up. But the part that actually changed how I rank these 3, the thing almost nobody mentions, is what happens at the other end when you take the money out. In retirement, every RRSP dollar you withdraw counts as income. Cross roughly $95,000 in income, and the government starts clawing back your old age security. TFSA withdrawals, invisible. They don't count as income at all. The FHSA's catch, it runs on a shot clock. 15 years from opening to buy that first home, or the money rolls into your RRSP tax-free. Not a disaster, but the tax-free house superpower expires. Flexibility ranking if life happens. TFSA, anytime, any reason, tax-free. FHSA, first home or the RRSP rollover. RRSP locked until retirement with a couple of narrow exceptions like the home buyer's plan. One TFSA landmine, before the verdict, pull money out and that room doesn't come back until January 1st. Recontribute in the same calendar year and you're into over-contribution territory. A 1% penalty per month on the excess. Don't treat it like a checking account. I nearly did. So here's the playbook. Buying a first home within 15 years, FHSA first in your 20s on an average income. TFSA plus FHSA. In your 40s, high income, expecting a lower bracket in retirement, that's when the RRSP earns its keep. So no, there's no single winner. You match the account to your timeline and your tax bracket. My personal order, TFSA first, then FHSA, then RRSP. Your numbers might flip that, and that's the point. Drop your fill order in the comments. I genuinely want to see whose team RRSP. If the TFSA is your next move, my video on the TFSA rules you actually need is right here. And subscribe if plain language Canadian money talk is your thing. Not financial advice, just a dad who read all 3 rule books so you don't have to.